All right, so we'll continue for, as I mentioned, the other tab on the website that we have is related to different investing ideas. And these ideas come from different sources. The low volatility was based on more fundamental analysis or from studies that were done regarding the market correction. This particular one, which related to the gold miner stock, it's actually based on the technical analysis, just caught my eye. And I know there is a lot of discussion and chatter on the media and TV about all the crises we have in Europe and Russia, Greece, and all this printing money, etc. And many people have good ideas about interest rate and gold, etc. However, the reason I came up with this kind of idea, it's purely based on technical analysis, and it would be nice if both fundamental and technical analysis will be on the same page. So before I go ahead, again, just keep in mind that I'll just do that very briefly because I'm kind of in half hour of our presentation and I want to keep time for the question period of time, but there is more information on the website. So the subject of this particular idea is to basically look at gold miners, meaning the companies that actually produce gold. And you could also invest in actual gold if you decide that this is something you like to have in your portfolio. And maybe it's not a bad idea. I'm not promoting one way or the other, but there are people that think that you should have some actual physical gold in your portfolio. And just by the way, this is outside the scope of this presentation, there is ETF which actually holds bullions of gold. The name is GLD. So it is actually as if you would buy a physical bullion of gold. So they have like big warehouses, safes that are secured, and at least in principles, they have to keep for every dollar that you invest that piece of gold to back up your investment. And in theory, that particular ETF GLD should go up and down at the exact the same percentage as physical gold that goes up and down. However, this is different from what I'm talking here. This particular idea is related to the companies that produce gold. And sometimes these two go together, meaning the actual cost of gold and the price of the companies that produce gold, but sometimes it doesn't because there is actually meaningful difference between these two investments. Once you invest in actual physical gold, the other one you invest in companies, and companies can do some very smart and good things, but can do also some other things that would be detrimental. And we all know that Barrick Gold, which is one of the biggest companies, had some issues a while back, and some companies have some technical problems with the mines, flooding, etc. Or they could have some management problems or bad management decisions, and one of them, companies do hedge their production, which means that sometimes hedging works for them, sometimes it doesn't. So there are many things that management of the company could do that could make a gold producer perform better or worse than the price of gold. And for these and many other reasons, it's not necessary that these two investments would do the same thing. So one of the ETFs, as I said, the symbol is GDX, and there are many other ETFs. And just to have you some feel what that ETF holds, it has Gold Corp, which is one of the major companies that produce gold, Barrick Gold, Newmont, Franco-Nevada, etc., etc. So all major gold producing companies are included in that particular ETF. And again, similar to the concept that we had before when we discussed the low volatility ETF, you could invest in any of these individual companies, or you can invest in a basket of many of these companies, which actually will reduce your risk, because if one of the companies have any issues and the stock would come down by a significant amount, the basket would not go down as much as individual stock. That's the whole concept of having a basket rather than focused investment in particular stock. So when we started that idea, and actually it was not very long ago, it was on January 6th, just a couple of weeks back, that's actually the chart that I looked at. And some of you I know that know a little bit about technical analysis. However, I think most of people, as far as I can see in our group today, are not very knowledgeable in technical analysis. And probably one of the future webinars we should have, it's about this particular issue of or subject of technical analysis. But you don't need to be a rocket scientist to understand and look at the chart. It's very straightforward. So this candlestick chart represents the price of that ETF's GDX. And as you can see, it's actually is going down. So starting from like last year, July, August, it would continuously go down and quite significant amount. It was like from 65, it came down probably about 60%. A very significant correction in stocks that actually considered to be very conservative, gold miners. But what happened recently, like November, December until now, as you can see, it did not continue that downtrend, and actually it stopped in here, went up and then down, and actually it's traded in the range. That's what in technical analysis we call kind of support level. And don't worry right now if you don't know the all intricate details, but what caught my eyes, actually, it came down again, but it did not break the previous low, which was somewhere in mid-November. And this is one of the setups that I like very much, because if you enter this investment in this point of time, you can have very tight stop, basically. And stop means that, maybe I should explain that because there are some people that are beginners. I'm doing the investing and trading for 20 years, and I probably did all the mistakes that anyone can make and cost me a lot of money, actually. And even today, in spite of the fact that I did gain some experience, there is no way that I could be sure 100% that whatever I invest today would perform or go up. So coming from that point of view, I always consider that if I buy particular investment, what if I was wrong, and how could I protect myself? And one of the way to do that is A, recognize that that is a real possibility, and B, taking some action. So before I enter any investment whatsoever, the first thing I have, and I would suggest that you will have the same, is a plan. You have to have a plan or a decision which will spell out exactly why did you decide to get into that investment, and monitor and see whether your hypothesis was correct. And if it's not, I want to get out as soon as possible. The smallest loss, the first loss, is always is the best thing to have. And so in this situation, because it's around this support level, I could have very tight stop loss in here, because if it goes below these levels, it's hard to see, let's say around $17, in spite of the fact that, I think it probably could go up, I definitely need to get out if that's happened, because that is a clear indication that my hypothesis was wrong, and I better find some other investment that would perform better. So that's the reason actually I came up with that idea. And again, I never know whether that will work or not. And in fact, even today, we don't know. We have to wait and see whether it actually meet the criteria. However, that was the actually graph or chart that I looked when I came up with this idea, and that's the reason being because of the support level. So what probably we should do is just the last part of this presentation is to come back to today and see what happened with that particular stock and how that performed. So this is exactly the same chart, and we are actually now, so this white line, actually this point here, let me just have the highlight. So this is the time that we actually made that decision to come up with this idea, and that's where we are today. Now, it did actually go up a little bit, but it did not continue a full uptrend, although it does indicate that it's working. In any case, it is what it is. So it did not hit yet my stop loss, and in fact, just stop loss is not necessarily designed for taking losses, and I don't like it. I will take it when it's needed, but it also to take profit. So since actually it did about 13% since that point that we initiated this idea, you probably, and I definitely will have a stop below these levels, so I can assure that I have at least a small profit before I exit this position. And since it did go up a little bit, I think these 2 points kind of indicative of a new support level. So if you remember, initially we said if I'm wrong, if the price goes to around 17, below 17 or 1650 or 1675, that would be an indication that the hypothesis did not work. However, since then, it did go up, and now I do not want to give up all this profit. So what I would do, I would actually raise my kind of criteria to these points, which are around 21, let's say $20.50. What that means is that I'm not going to sell it right now just because whoever said what, but I will be watching and see what happened with the price, because that's the most important criteria for me. So if the price will continue up, I will be happy camper, we'll keep holding that. But if the price goes, let's say, to below 21, to me that means that it's not in uptrend and it's time to take some profit. But I will make the final decision at that time if and when that happens. So that very much would conclude the presentation. And before again we go to questions part of the presentation, and we have question and answers obviously. I would like to mention that I'm running several courses. Actually, I run for more than a year a course at Ryerson University. I'm taking a break right now for all good reasons, but we will resume these courses in springtime. I did not decide yet the exact dates. It will be probably around the end of March, April, May period of time. And there will be 2 courses, probably the same or similar, one in Ryerson, and one I consider many people ask me to do that in North York, or probably I can do that online as a webinar. And the name of that course, it's Practical Personal Investing. What I like to show you is what is that about. So in essence, this is a very basic course, but I think it's very important, critical for beginners or people that are already investing, is to have a very basic fundamental understanding how the market works. And before you have it, I think it would be detrimental if you just listen to these other ideas if you don't have the full picture and full understanding about different points of view and different analysis that people do when they decide to invest in certain stocks. So this is basically the scope of that course, and you can make your own decision whether you would like to join these courses. So in first week we actually review different types of investments, and we could discuss like ETFs or stocks, etc. Now this is a very practical course, and we will talk not only about the theory but the practical application. So when we talk about different investing, and I'll talk about kind of financial advisors as well, and the fees that people pay. And again, I would think that most of you do have financial advisors, and they do have place in our investing decisions. But you want to make sure that it's worthwhile the fees that you pay. So at the end of this particular, the very first week, I'll show how you could actually invest and perform the same or better than the average financial advisor. And then we'll talk about diversification and asset allocation, which is a very important concept. We then on week 3 talk about buy and hold strategy versus active investing. And the week 4 would be fundamental versus technical analysis. So you would have at least some basic understanding what that means, what is technical analysis and what fundamental analysis. You would not be able, obviously, in this short period of time. Each presentation is about 2-3 hours. So there is no way that in 3 hours you would be an expert in technical or fundamental analysis. But what that will help you is to understand what that means. So if you hear someone talking about value or growth investment or bottom up or top down analysis, you would know what they talk about. Or when you hear someone talking about support resistance or market overbought or oversold condition or MACD, other indicators, you at least would know what they're talking about, and this is related to technical analysis. And the next concept we discuss in this course is sector rotation, and this is super critical for everyone to understand because that's happening every day. Money does not just disappear from the market. Money moves from one sector to the other, and it is like fashion. Sometimes women had the long skirts, short skirt, mini skirts, and the mix of skirts. And same thing in the markets, unfortunately or fortunately, which makes a lot of fun. Some sectors become in fashion and people like it. So energy is the most recent example. Everyone was talking just a couple of months back, you must have energy. Oil would go to $200, etc. And then it came out of fashion, and the whole sector corrected 30-40%, and some stocks even more. And would that continue to go down to zero? Probably not. So it will change around and come around. But there are tools that you can use to see which sectors are coming into or from the kind of likelihood of going up and down. And one of the concepts we discuss is money flow, because big companies actually moving money, and it's like a big elephant walking, and they leave some trails, they leave some signs for you. And if you pay attention, you could see where the big money moving from one sector to the other, and it could give you some early warning that things happen, right? So that's something that, although again, you need to probably study more about sector rotation, but will give you a little bit better understanding and answers to questions why, for no reason, the energy stock came down. Now, I say no reason, and I'm sure that every one of you jumped. Yeah, there were reasons. Yeah, and right now everyone has good reasons, because Russia, because Saudis, because there is no demand. But I did not hear anyone talking about these things before the correction happened. We're all smart in hindsight and can pretend that we are smart, but none of these people said, let's say back in May, June, that the oil would go down to $50. Nobody said that. So for that reason, it's very important to understand what's happening in the market to be a better investor. And the last session, this course, it's market psychology, which I think is the most important part for you to understand the market. So that's the course. So what I would suggest, send me actually this feedback, as I mentioned before, whether you'll be interested in that particular course. The one that is going to happen in Ryerson is very much set to this curriculum. However, the one that I'm considering, and it's not a done deal, it depends whether there are enough people are interested. I would be flexible and change the agenda or curriculum based on your response. So I would really appreciate if you send me a feedback saying whether you're interested on that subject or anything else. So I would like to thank you for your attention. I hope that was somewhat useful, and I think we'll just go back, and I will unmute. You will be able to actually talk and ask the questions. You could at the same time use the chat window to ask the questions. So just be careful. I would really appreciate if you would just reduce the volume in your speakers. Otherwise, we'll have some echo and problems in audio. Any questions? Yeah, that's great. I appreciate that people would like to attend the course. So whenever you're ready and interested, please send me this feedback. I know that some people are typing the questions. By the way, can you hear me? I can hear some echo in the background. Can you hear me? Okay. Some of the people in this room actually had questions related to PE ratio and PE multiple and expansion and PEG PEG ratio. So while I'm waiting for the questions, I could talk about, and one of the sources or good books is William O'Neill, How to Make Money in Stock Market. Most people are familiar, and he talks there about PE multiple expansion. What that means, and it's a concept that sometimes it's not easy to understand. What that means, each stock represent actually a company, so it's a real company with real business. And when you evaluate a company, you should consider that as if you want to buy the whole company. So what would be your consideration, how much you would pay for a company? As anything in life, it has price. The company could be great, but is it worth the money that you're going to pay? So that's a very basic fundamental question. And it's not easy to answer. There's no simple yes or no or formula that you can use. There are also many different criteria. However, most common and very probably the most important criteria is earnings that company has based on their business. So obviously the more earnings the company has, the more value it has. So if you have two companies, company A and company B, and one company earned X amount, let's say $1, the other company earned $2, obviously company that made the $2 would be valued more than company that earned $1. So now the question, how much you pay for the company you pay that made $2? So do you pay twice as much than the first one, or maybe 50%, or maybe 300%? So to analyze that, what you basically want to do is to look at the price divided by earnings. So that's what's called PE ratio, price versus earning. And different companies have different ratio. Now, this PE ratio would depend on how much a company grows. If it's growing fast, you're probably ready to pay more for that, because you will make in the future more money, because they would sell more gadgets like Google and Facebook, versus gold miners that they may grow but not as much as these technology stocks. So typically for fast growing companies, the PE ratio is much higher than utilities companies. So if you talk about utilities companies, depends on which market, etc. But you talk about traditionally 7, 8, 10, I mean the PE ratio for these companies. However, if you talk about fast growing companies like Facebook, I don't know what their current PE, but I would not be surprised that it's 50 or 20. It's definitely more than 20. It's probably 50, 60, 70. And the only reason that people are ready to pay so much for that is because they're growing much faster than other companies. So a company could start with low PE, and then they would come up with new products or some new gadgets or whatever ways, and will generate more earnings. And based on that, a company, let's say, could have a PE of 20, but because they had this new development and would start growing faster, their PE ratio will expand. So from being 20, it could become 20 and 30. And that's what William O'Neill actually talked in that chapter that someone asked about. It's the multiple expansion of PE ratio for certain companies. So a company could be the same, but if the multiple expands, the price always will go up. So the question is, again, when it goes up, how much is too much and how much it's reasonable to pay. So the other criteria to look at would be the PE ratio relative to the growth of the company. So if the company grows 10%, you probably don't want to pay more than PE of 10. But if the company grows, let's say 30, 40, 50% a year, you're probably ready to pay higher multiple. And that in essence answers the question about multiple expansion. Okay, I will pause again and wait for your questions. That's a very good question, and it goes back to the course that I suggested that some people may want to attend, and it's related to diversification and the asset allocation. And what that means is that you want to look at this subject from the risk point of view. So if you invest in one stock and put your all investment in that particular stock, there is nothing wrong with that. The only problem is that you have to make sure 100% that it will perform as you expected. So there are some gurus that say, they can guarantee 100% that you'll make money, etc. Reality is that would never happen. So there is a certain risk every time that you invest in something. And to reduce the risk, you want to invest in more than one, because if I'm wrong in one of the investments, I don't want to take such a big risk that my entire investment portfolio would be affected so much. So I want to invest in more than one. And then your question is great. So how many? And there is no simple answer, unfortunately. There is no like mathematical formula. I think it all depends on you, how much time, efforts, and knowledge you have to manage. And I would say just a range. Obviously, you probably want to have more than 5, 6, 7, 8 different investments. But it's not only different investment, it's very critical to understand what kind of investment, because and that's part of the course that we will go through. It's not enough to have, let's say, 50 different investments. That may not necessarily reduce your risk, because let's think for a while. If you invested in Suncor and Canadian oil sand and Imperial Oil and ConocoPhillips, you could invest in 100 different companies, but all of them are in energy, oil and gas sector. And guess what? For whatever good reason, the entire sector is correcting. Then what will happen, in spite of the fact that you had 100 different investments, which is a huge diversification, you probably did not do a good job of reducing the risk. So what I'm trying to say, it's not necessarily how many, it's how you do that. You have to make sure that if you have different investment, and if the purpose is to reduce risk, you invest in different sectors. And in that course, we talk about term, it's a mathematical scientific term called correlation. And correlation means how one security or investment correlates to other. So if I talk about Suncor and Imperial Oil, they have very high correlation. And for that reason, these two are not good candidates to diversify your portfolio. But on the other hand, if you talk, for example, Google and Suncor, these are not very much correlated. There is some correlation, obviously, but it's not as much as the same sector. So when you talk about how many different investments you should have in a portfolio, it's more important to understand how you diversify and in what sectors, and how you allocate your assets than how many. So that's a general kind of answer, and if we have time, I can expand more on that. From practical point of view, there are some portfolio managers that have like 50, 60, 70 and more investments in their portfolio, which means that each of the investments is a very small portion, which is good, because then you're taking less risk. As long as all 50 of them are in different sectors and have very low correlation to each other. Now, from my personal point of view, and this is my just experience, I would like to have many different investments, but you also have to keep in mind that you have to manage, because if you have 50 different investments, you have somehow to follow up and have your criteria kind of evaluation periodically, etc. Use a computerized system, fairly sophisticated tools, which automate my entire process. However, in spite of that fact, I found it extremely difficult and time consuming to properly manage more, I would say, than 12, 13, 15 investments. And I really don't think that you could and need to have more than that. So that gives you some range, basically, at what you could expect as far as how many different investments you should have. Again, it's all personal. But part of your investment criteria also should be based on, as I mentioned, correlation. And I personally look also on shorting the markets when needed or going to cash, which you should consider that as another kind of part of your portfolio. Because if you concerned that the market go down, probably cash position is one of the positions you should have. And if you're a little bit more sophisticated, you should consider selling short because that's when you will make that's when you will make money when the market goes down, right? Now, if you are not as sophisticated, no problem. There are many ETFs that actually selling short for you. So you buy them as a single investment, and the portfolio manager actually doing that background work for you. And some of these ETFs are designed to go up when the market go down. However, I would strongly suggest that you'll never touch that before you fully understand how that works. And that's something we could have another webinar probably if you're interested. But that's a very important part of diversification and asset allocation, and in the concept of risk reduction, to have something that will perform better than the market when the market corrects. I hope that answered the question.